Good afternoon and welcome. So, on behalf of Brandeis University, it's my pleasure to welcome you. My name is Debarshi Nandi. I'm the Barbara and Richard M. Rosenberg Professor of Global Finance at Brandeis. And our welcome to the Brandeis sponsored event for the Boston Fintech Week. Our panel this afternoon is with Professor Steve Cicchetti and Professor Eric Rosengren, who would be talking about central bank digital currencies. So today's events are sponsored by the Rosenberg Institute of Global Finance, the Perlmutter Institute of Leadership in Business, and the Graduate RAB School of Continuing Studies and the Graduate Professional School of the Brandeis University. We would like to say that we have been a part of the fintech ecosystem for a very long time. We have 2 programs in fintech, and we are very happy to be collaborative with the Boston Fintech Week events and the Fintech Sandbox events and everything that has been built in Boston. I would like to acknowledge my colleagues in the room, our Dean, Katie Grady. Thanks, Katie. Vice President of the RAB School of Business, Lynn Rosansky. Lynn, come on up. My colleagues, several colleagues are here. So I'll thank all my colleagues, and I would especially like to thank the organizing committee that has been so helpful in putting all of this together. Kim Ersirian, Debbie Berkman, Michaela Henry, Alina Hicks, Gina Parenti, and Mara Dzik Swanson. So thank you so much for helping us put this together. It's my pleasure to introduce my colleague, Professor Steve Cicchetti, and our honored guest, Eric Rosengren, for this event. Steve is the Rosen Chair in International Finance at the Brandeis International Business School, and the Vice Chair of the Advisory Scientific Committee of the European Systemic Risk Board, Research Associate of the National Bureau of Economic Research, and Research Fellow at the Center for Economic Policy Research. From 2008 to 2013, Professor Cicchetti served as the Economic Advisor and Head of the Monetary and Economic Development at the Bank of International Settlements in Basel. During that time at the bank, Professor Cicchetti participated in the Basel Committees of Banking Supervision and Financial Stability Board, post-crisis global regulatory reform initiatives, and establishing new international standards for ensuring financial stability. In addition to all his other appointments, Professor Cicchetti, from 1997 to 1999, served as the Executive Vice President and the Director of Research at the Federal Reserve Bank of New York. And from 1992 to 2001, he was the editor of the Journal of Money, Credit, and Banking, which is one of the leading journals in this space. So without further ado, let me hand it over to you, Professor Steve Cicchetti.
Thank you very much, Debarshi, and thank you for that very kind introduction, which I think is mostly just a sign of my age. As you get older, the list gets longer. You don't actually have to it's a sign that you're breathing. So it's my great pleasure to welcome it's on. What, you want me to move it up? Ooh. Okay, how about that? Is that okay? Okay, it's my great pleasure to welcome my old friend Eric Rosengren. Eric, in addition to having a PhD in economics from the University of Wisconsin, he has served for more years than I'm going to count at the Federal Reserve Bank of Boston, just down the street. And in the year 2000, he did something very interesting, which is to become the head of supervision and regulation at the Federal Reserve Bank of Boston, something that research economists generally don't do, but I think is a sign of Eric's interest in financial stability issues very early on, and understanding of the importance of the relationship between macroeconomics, monetary policy, and financial stability. But starting in July of 2007, Eric became the president and CEO of the Federal Reserve Bank of Boston, where he was until September of last year. And he now has a bit more time, and so he can come and sit with us this afternoon. Let me just say that I'm going to just one more small thing that we're going to come to, and that is that related to the topic today, during his time at the Boston Fed, at least over the last few years, Eric was involved in something called the Project Hamilton, which we will talk about a little bit, which was a joint venture between the Federal Reserve Bank of Boston and the MIT Digital Currency Initiative to explore the benefits and design choices for central bank digital currencies. So I cannot think of anyone who is better equipped and better qualified to talk about central bank digital currencies. So let me start by asking the simplest question, which is, why do we care about this? And why is it that central bank digital currency would be any different from just cash, which I don't actually even have any right now?
Well, I have some cash. Central bank digital currency actually serves the same role that cash is when it's implemented. So think of what cash actually provides. It provides an anonymous transaction. I don't pay any transactions cost to be able to have cash. I can go to the bank, I get cash, there's no transactions fee. So it's very inexpensive to be able to go out and do transactions. Now, the reason everybody accepts dollar bills is because it's legal tender. So it's part of the Federal Reserve Act that dollar bills are legal tender. Now what you actually have is a zero coupon bond. So when you have money in your wallet, what the Fed has is it's given you these pieces of paper, and in return they go out and buy bonds that carry an interest rate. That's what enables the cash to basically be free to us. It's not that it's free. If you go to the Federal Reserve Bank of Boston and walk in the lobby, you see lots of people with guns because all the cash is in the basement. So you need to guard cash. You also need to distribute cash. You need to take cash from central depositories to banks. So it's not that actually it's a free good. It's really that the government provides it free to individuals, which is one of the attractive features, and why if you're in low-income areas, you see a lot more cash than you see in other places. Now, there's certain things that cash can't do. And if all you have is your wallet with cash, you can't buy anything online. So cash is great if I'm meeting person to person to make a final transaction, but it doesn't do me any good if I'm trying to do something over the internet. So that's certainly a problem because a lot of purchases are being made over the internet. So digital currency that's being implemented in some countries, let me just start by, this isn't just theoretical. There are some countries that have already implemented. They're at the early stages, I would say, but they have nonetheless implemented. They may not be the countries that you would necessarily expect. So Nigeria has a digital currency. Jamaica has a digital currency. Bahamas has a digital currency. And the East Caribbean Islands have a digital currency. Those are not technology havens around the world. So why does it make sense for these kind of countries to adopt a digital currency? And I think there are a couple of reasons. One is if you are a fairly low-income country, a lot of people don't have bank accounts. So in Nigeria, only 45% of the people have bank accounts. So if you have a very large unbanked population, there's a real advantage to having a digital currency that doesn't necessarily have to go through the banking system. You can design it to go through the banking system, but it doesn't have to necessarily. A second aspect is that remittances are really important in these countries. So in Jamaica, 22% of GDP is remittances. Now, if you think about remittances, so remittances aren't probably very important to most people in this room. But if you're a farm worker in the Southwest and you're sending money to Honduras or Guatemala, finding a way to safely do that is not straightforward and tends to be extremely expensive. So sending money across borders is very expensive. But if I have a digital wallet and one of my relatives has a digital wallet that happens to live somewhere else, I can make that transfer, and I don't have to pay all the fees that commonly are associated with these kind of cross-border transactions, particularly for low-income individuals. A third aspect is that a country like Nigeria has a very big underground economy. It is basically a cash economy in many respects. And so a digital currency would actually bring more of those, more transactions, presumably, back into a taxable arena. So there are some advantages to a government that has a very large underground economy to incent people to try to do transactions where there can be a digital record. So I think the best use cases are actually in third world countries where the discrepancies for low-income workers is quite substantial. Now, we have low-income workers, obviously, in the United States, not to the same degree as a place like Jamaica or Nigeria, but 5% of Americans don't have a bank account. So that doesn't seem like a huge amount, but we're a pretty big country. That's 15 or 20 million people. That actually is a lot of people. If you're an undocumented worker in the United States, not that easy to get through the Know Your Customer Bank Secrecy Act requirements to be able to open up a bank account. So there are a lot of people in the economy that would benefit if they didn't have to do everything with cash transactions. In many respects, also, it's safer. So in some of these countries, having a wallet full of cash is not the safest place to be, where if it's on your phone and it's digital, you probably have a little less concerns about necessarily being robbed or pickpocketed. So I think there are a bunch of reasons for why we've started to see the development in some of these third world countries. They haven't tried to do it by themselves, so they take on tech partners, and there basically is an off-the-shelf opportunities. A long-winded answer to your short question?
I didn't know what time we started.
I saw you want to look at it.
No, that wasn't very good. I just want to remind people, for those of you that are, Nigeria is not a small country.
It is not.
Nigeria has 200 million people in it. It's a very big, it's the biggest country in Africa by far, and it's one of the biggest countries in the world. So this is not a small thing. Just to pick up on one of the issues that you just raised, it's the issue of you mentioned the Bank Secrecy Act, but you still have to do identity verification. So how is it that if we have central bank digital currencies, or how is it they are doing various types of know your customer, anti-money laundering, anti-terrorist finance, sorts of things?
So as you might expect, most central banks don't think they're experts in know your customer kind of regulations. And so as a result, all the countries that have chosen so far to have a digital currency have chosen a model which I think is the likely model if the United States or Europe goes down this road, which is they'll have financial intermediaries do the Know Your Customer Bank Secrecy Act. So when you open up an account, you have to show a passport or a driver's license. They want to make sure that you're not an illegitimate business. If you start doing cash transactions in and out of the account that make it look like you're selling drugs or doing something else illicit, they may close your account. So, and that will be true even with cash. If you make very large cash transactions, a bank might be required to file a SARS report, that basically a suspicious activity report, saying that there is a possibility that this is being used for illicit means. So one of the real concerns with the digital currency is that the same kind of Know Your Customer and Bank Secrecy Act and avoiding terrorist finance actually gets implemented with a digital currency. And the way they get around doing that is the banks or other financial intermediaries, it doesn't have to be a bank. So in all the countries so far that have adopted a digital currency, they do have banks doing these activities, but they also can license non-banks. So you could think of a fintech that certainly would be able to do this. You could think of an organization that did nothing but Know Your Customer Secrecy Act in inner cities to make it widely accessible, for example. So while it could be through the banking system, it doesn't have to be through the banking system. That's one of the advantages of a digital currency. It a lot of the things that the Federal Reserve designed, and the Fed is an operator of a lot of systems, but it's really tied to the banking system. But if what you're trying to get at is people that don't want to use the banking system for one reason or another, then just going through the bank rails doesn't really help. So one of the big use cases for the digital currency is getting to those people potentially that otherwise wouldn't have access to financial services, wouldn't be able to do transactions on the internet.
So what you're suggesting is that we want to shift away from the current payment system where we have everything basically settles in one way or another on the central bank's balance sheet, whether it's currency that's being exchanged, which is the liability, or whether it's my making a payment that's bank to bank. You're suggesting that we can move away from that with central bank digital currency.
It would not have to be bank to bank. So the Boston Fed is doing something that's called a real-time payment system, which, without going into a lot of detail, it just means it's final payments and it happens virtually instantaneously. And that's going to be coming out in probably the next 6 to 9 months, but it goes bank to bank. So if you don't have a bank account, or the person you're sending the funds to doesn't have a bank account, it doesn't work. The beauty of a digital currency, just like when I do a cash transaction, if I buy something from you, I don't know if you have a bank account or not. It doesn't even cross my mind. You take the cash, I take the item. It's a final sale at that point. And this would have the same attribute as that kind of transaction.
Right, just so that people get some sense of this, a number of central banks are currently running retail payment systems. They're very, very fast. You know, payment is settled in a couple of seconds, and they're potentially very, very cheap, say on the order of, 0.2 cents or something like that per transaction. Let me turn to more about there's been a lot of criticism of central bank digital currencies. Earlier this year, for instance, the Economic Affairs Committee of the United Kingdom's House of Lords issued a detailed report that was entitled "Central Bank Digital Currency: A Solution in Search of a Problem." So, what do you see as the potential downsides of this, and are there ways that we can handle those?
Yeah, so there are potential downsides. One of the potential downsides is you worry about disintermediation, which just is you quickly take funds out of a bank. And the time you're most likely to quickly take funds out of a bank is when a bank is in trouble. And so creating banking crisis is not a very good attribute. There are plenty of controls that you can put in place to limit that. And the way to think of this is there are plenty of ways to actually run on a bank. The old-fashioned way during the Depression is you stand in line and you take your cash out. Well, this is digital cash, so it's not that different than standing in line. But what most countries have done is they put a limit on how many transactions you can do, and how much it can be. So with my wallet, I'm not going to keep tens of thousands of dollars in my wallet. I normally wouldn't have more than $300 or $400. So if you're keeping relatively low balances on the electronic wallet, that's the digital currency, then I think you limit a lot of the disintermediation concerns. And I think there are plenty of ways to pull money out of a bank now. FedNow is going to have that same ability to pull funds out. And there are plenty of other ways to get your money out of the bank if you want to get it out quickly. So I think there are lots of financial stability concerns with banks being concerned about runs, but that probably isn't high on my list because I think it's relatively easy to control. A second thing you could be worried about is, particularly if you were a third world country, is people running from your currency to go to, say, the US dollar. So let's say I'm Jamaican and I can have a wallet with Citigroup that keeps up to, say, $10,000 in a digital wallet. How concerned would I be that if Jamaica starts having monetary policy problems or financial stability problems, that everybody flows out of the country and into the digital wallets? Again, the digital wallets are limited. It really is meant to be more like a wallet in your pocket or a purse that you're carrying. It's not meant to be kind of a savings account or a real way to hold significant assets. Think of this much more as a transactions account. How do I make relatively low denomination? And to the Bank of England report, I mean, I don't make a lot of transactions with cash because I'd prefer to get the frequent flyer miles. But I have no problem getting credit. There are a lot of Americans that are not in that position. So you could have not paid off a loan, you could have declared bankruptcy. For a variety of reasons, you may not be able to get a bank account, or you may just find that a bank account is way too expensive. So frequently people find that the fees that are charged for a transactions account, many banks require a minimum deposit. Many banks charge fees for checking accounts. If you're low income, that's a high percentage of your income. So there are a lot of reasons to think that some people will benefit if we design it appropriately.
Right, I guess on that last point, I guess I don't go to the right neighborhoods, but most of the time, but I think when I do, sort of either by accident or intent, I do still see places that are cashing checks, right? And so I guess one idea is you want to put some of those people out of business in certain ways.
Exactly right. And I was in Charlottesville at University of Virginia, and we were about 20 miles out, and I had to drop my daughter off somewhere. And I went into a mall, and it obviously is a mall that hadn't done particularly well. It had a dollar store, it had 2 fast food restaurants, and it had 3 cash checking places. So there must have been enough demand and supply to keep 3 different providers in this kind of decrepit mall operating. And they're paying a fair amount of money just to be able to cash, presumably frequently checks from the government or from their employer. With a digital currency, you wouldn't have to do that. And I think the hurricane is another good example. A digital currency, you can transfer funds. You don't have to go to a bank. Right now, if you're in Naples, getting in your car and going to the bank isn't going to be very easy. Your car is probably a couple feet under salt water, and it probably won't start once the water recedes. So getting emergency funds to people, much easier if you have a digital wallet than if they have to send you a check or transfer it in some way that requires you to actually go to a bank. So I think in emergencies like hurricanes, earthquakes, other things, it's a quick way to get funds to people. You could also think of situations like during the financial crisis when there were large transfer payments sent to people. If lots of people had digital wallets, you could send it fairly quickly to people. It would get into the economy. It would probably be much more efficient than the mechanism we use now.
And just bringing back to the migrant workers, how do you see that? How do you see that working?
So, even low-income people tend to have phones, and all you need to do a digital currency is a phone. It basically is a bank account on your phone, and so for the transfers, I would assume that people would have a wallet and have their relatives have wallets. It would immediately transfer. Now, right now, places like Guatemala, Honduras, where it's very unsafe to go to a bank, they have a lot of gangs. People do worry about being robbed after they get funds from relatives that are in the United States. So being able to do it electronically avoids a lot of that risk. Now, we don't have a digital currency right now. Some of them are using stable coins in order to do those because it's less expensive. Stable coins have a lot of features that a digital currency have. Unfortunately, they haven't been so stable. So if you pick the wrong stable coin, you could potentially lose all the funds that you put into the stable coin. This would have the full faith and credit of the United States. It would be legal tender. So you wouldn't have the same risks that you might have by putting it into account like...
Would you envision interoperability between central bank digital currencies issued by different jurisdictions?
I would think that it would be very easy to be able to program getting different exchange rates.
So for instance, if I were to want to send dollars to somebody in Mexico, I could transfer them into pesos in some way that was relatively seamless.
Yeah, it's not.
And I wouldn't have to worry about the 5% or 8% charge that Western Union is gonna make.
Yeah, I mean there may be a fee for doing the conversion, but it would be a lot cheaper than Western Union, right, which would be probably more than.
So I guess I'm right. So yes, I'll shed tears over Western Union the same way I will over the check cashing over the check cashing shops. Just sticking with the downsides, you didn't mention the concerns about privacy. Again, you did say at the beginning that if you go out and you pay somebody with a $20 bill or something like that, that's totally anonymous. This would not be, I don't think.
Yeah, so it's not going to be totally anonymous because they don't do an identification every time you transfer a dollar. But for a digital currency, the way it would likely be set up and the way it's been set up in places like Jamaica is that whoever sets up your account has your personal information because they have to have the know your customer kind of requirements. But the government itself doesn't get any personal information at all. So the bank has whatever information it necessarily has in order to meet the obligations under bank secrecy, AML types of things. And the government can get aggregated information not tied to the individual. Now, it does require a certain level of trust. And you don't necessarily have to set it up that way. So you could easily imagine in China or some other places where they may not value privacy to the same degree, that it may not have those features. But this certainly could have the features that would limit your privacy concerns in many respects. If you're using a credit card, people are probably selling your credit card information on the internet. If you buy things on the internet through Amazon or Facebook, you're already giving up an awful lot of privacy. My guess is that appropriately designed, the digital currency would give you far more privacy than many of the types of transactions that people are currently doing.
Do you see digital currency as something that would pay interest? And we'll come to why that's important in a second.
So I don't. I know a lot of economists would like it to pay interest, and I am an economist, so, but I really view this as a transactions account.
Okay.
And in the same way that the cash in your wallet doesn't carry any interest rate, and one reason you don't want to hold huge balances of cash is because it doesn't pay an interest rate. So as interest rates go up, your desire to hold a lot of inventory of cash goes down. Now, when we've had several years where interest rates have been virtually zero, the cost of holding more cash is quite low. But as we have a more normalized interest rate environment, most people only keep money in their wallet for transactions because they'd rather keep money in the savings account or something that gives them a return. So I think it actually makes sense to make a digital currency a transactions medium, not a savings medium. If you start paying an interest rate, you do now have to worry about disintermediation with the banks to probably a larger degree. And I also think that more than likely, currency would be in parallel to digital currency. So I would not foresee them saying you couldn't use currency for legal tender. You could use either digital currency or paper currency. That's the way all the countries that have been implementing it have implemented it. I think if you outlawed currency, that I think it would be politically very difficult in the United States and in many other parts of the world.
So do you think that, again, the politics of this, and I have a couple of questions about that are related to the interest rate. The politics of this seem, at least on the surface, from my perspective, is slightly fraught because you do pay interest on private bank deposits at the Federal Reserve. So their reserve deposits, which are their version of this, are interest bearing. So do you think that you can have interest that you're paying to banks but not individuals?
You currently don't get any interest on your currency.
Well, and I'm very irritated about that.
Well, not everybody's it's a free good
seems
for you.
Quite unfair.
You're not paying any
fees. And look at how much I have as a consequence of it. There's like nothing in there. I have absolutely. I literally right now have. I literally have no currency with me at all. Well, and as I entered the garage this afternoon, there was a sign that said "No cash," so I can't even pay for my parking with cash if I had it. So.
I mean, I do view it as so what you're thinking of is the reserves that a bank holds for its reserve requirements or holds in excess reserves. That's an institutional market. I'm really talking about retail CBDC, right, where it's really a transactions account.
But back to the no interest. So that means that the interest rate on central bank digital currency is there's a floor at zero. There's also a ceiling at zero,
Both
but there's a
floor
floor.
and a ceiling. Right.
There's a floor at zero. We've seen a number of circumstances. Now, maybe this is never going to happen again in any of our lifetimes, because maybe we're back to having inflation, but hopefully not. But we did see a lot of central banks and a lot of policy rates go below zero. And one of the things that people have said about central bank digital currency is that it would provide an opportunity for central banks to lower interest rates below zero. Do you see that?
I don't. I don't think there would be, if you're going to allow it to go negative, you're going to have to allow it to go positive. I think people would resist anything that gave them a negative return. And so I think it's pretty unlikely politically that there would be an interest rate paid. And you do have to worry about disintermediation as soon as you start having a return. One of the reasons why you don't want to keep much of it is because it doesn't give you a return. But the return that you're implicitly getting is I can make transactions and I can go buy a newspaper or a bottle of water and I give them cash. It's a small transaction. I mean, in many respects, it's inefficient for me to use a credit card if all I want to do is buy bottled water, because the transaction fee is probably a significant percentage of the cost of the item, where if it's digital currency, that wouldn't be the case.
Okay, well, I guess we'll see. I mean, there has been tremendous resistance in this country to go to negative policy rates anyway, for reasons that we don't need to get into. Let me turn now just to the Federal Reserve's own perspective on this. So, in January of this year, after the Federal Reserve issued a discussion paper that was entitled "Money and Payments: The U.S. Dollar in the Age of Digital Transformation." It turns out to be all about central bank digital currency, even though it's not in the title. They invited public comment on a series of 22 questions. And I guess there were thousands and thousands of public comments, including mine. But I did sit down and answer all 22 questions and put them out there. But I'd be interested in your answers to a few of them. So the first one gets us back to where we were, which is, could some or all of the potential benefits that you listed, could they be achieved in a different way?
So they could be. I mean, one of the Fed now is going to actually make it easier to do a low-cost transaction bank to bank. So for people with bank accounts, Fed now is going to be very similar to a digital currency. Unfortunately, a lot of people don't have bank accounts. And so I think the part that gets missed is how many people are still either underbanked or unbanked. And so I think that really is the use case that's critically important about the digital currency. And as I said, there's a reason why third world countries are doing it, because those gaps are much bigger in low-income countries than they are in the United States. And many of the people that set policy don't think about paying money to cash a check. And so frequently it doesn't get nearly as much into the policy debate as it probably should.
I guess that's because we don't go into the right neighborhoods, most of us. But on this issue, maybe this is not a good example because maybe it's not transferable anywhere else. But the example of India comes to mind when people talk about unbanked and underbanked populations. The combination of identity through everybody has a 16-digit number, and basic bank accounts that are subsidized over a fairly short period of time, I believe 3 to 4 years, brought almost 450 million people into the banking system. Why can't we do something like that? Why aren't we working through identity and subsidies to bring people in?
So you could, but there's a cost to subsidies. And how much of a subsidy would you need to get a bank to provide a completely fee-free checking account that gave you the kinds of attributes that somebody would want? I think another aspect is that you just go into Roxbury, there are not many banks. There are not many ATMs. So even the access to, in effect, a storefront is very different in low-income neighborhoods than it is in wealthy neighborhoods. There's a reason why banks want to have customers that are well-heeled. They can cross-sell them all kinds of other products that give a much higher return. So banks could right now, if they wanted to, cross-subsidize low-income individuals. And some banks actually do have accounts that are very low cost or no cost. They don't push them, and they don't necessarily encourage people, and they don't tend to open up in the neighborhoods that most need it.
When you started a few minutes ago, you said that we're actually subsidizing the issuance of paper currency, of cash. The Federal Reserve is doing that. Presumably the Federal Reserve is also going to subsidize the issuance of central bank digital currency. This isn't going to be free to provide, right? There'll have to be technology. There are going to be costs. So the question is, why not take those subsidies and...
So it's a political economy question in part, and this is a little subtle, but I think most people don't think of the currency in their wallet as an interest-free loan to the government. And so it's basically an off-balance sheet item. The Fed turns money back to the federal government at the end of every year. That reflects the fact that its costs are less than the interest they get on the bonds that are held by the Federal Reserve. If you do a subsidy, the Fed is not normally in the business of sending cash out to people to subsidize, so it would probably take legislation. And my own guess is that the legislation to put a subsidy to help banks provide low-income services might not be one of the first bills that gets through the House and Senate after the election.
Right, and I guess my other idea of getting the post office to do it would have the same problem. Well, they have a lot of, the post office has branches everywhere, so even in Roxbury. And in a lot of countries, that's what they do. The next one of the 22 questions that I was gonna put to you is, I'll just read it. How might a U.S. CBDC affect the Federal Reserve's ability to effectively implement monetary policy in pursuit of its maximum employment and price stability goals?
Yeah, so I don't view it as a huge impediment, in part because I'm viewing this as a transactions account like cash that's going to hold relatively small amounts. So to me, depending on what the substitutability is between currency and digital currency, I mean, it's not clear to me how much total currency increases or decreases. We'd have to see what the acceptance rate is. But I doubt it would raise to the point of being a monetary policy issue. As you pointed out before, it does have the attribute that when interest rates get very low and possibly negative like they did in Europe, that cash currency and digital currency would be an attractive asset. Certainly when I was at the FOMC, there was no desire to have negative interest rates. I'd be pretty surprised if anytime soon the FOMC, first of all, I don't think we'll have the economic circumstances for it, but second of all, I don't think there'd be the interest among the participants.
Not for a while anyway, let's hope.
For a while.
Yeah, just my nightmare is that roughly half of the bank accounts, the deposits in banks are uninsured. And so that's a number just in, round numbers of probably almost $10 trillion right now. So my nightmare is that becomes central bank digital currency, right? It flows out. You say, well, I've got an insured account. That's basically government money. But now I want government money because I'm worried about the banks, and so I get $10 trillion going into that. You don't see that ever happening.
So a lot of those uninsured accounts are doctors, lawyers, and municipalities. And so a doctor or a lawyer, if they can have a digital wallet for $1,000, it's not going to solve the problem that they have so much.
Well, they could have you're not going to give them one for $1 million is the point.
Right. It's going to have a low transaction. It's a transactions account. So I don't view the uninsured, this doesn't solve the uninsured deposit problem. It's a small enough account that I don't think it would make that much of a difference.
I'll turn to the audience here in a couple of minutes, and we'll take some of your questions because so that you'll get bored with mine after a while. The next one is about cash usage. Is it important to preserve the general public's access to a form of central bank money that can be used for payments if cash were to disappear? As I just want to point out, it has been disappearing in some countries. I mean, most prominently in Sweden.
Though in Sweden it occurred because they forced it. So I'm not sure how voluntary it was by the population. I mean, an interesting aspect is, despite the fact that you don't use much cash, the currency outstanding has been going up. One of the reasons is because it's used internationally, and there are countries that use the dollar as their own currency. A lot of that demand is foreign demand for US dollars. But I don't see us going to a cashless society unless it's forced, and I don't see there much political will to force it.
So that's interesting that you mentioned the increase in cash holding, the cash outstanding, which somewhat surprisingly to me actually accelerated in the pandemic, right? I mean, it was increasing, and then all of a sudden it took this faster jump upward. Most of it's $100 bills. I don't know about the rest of you, but I'm not big into $100 bills. I actually have a couple of them, not on me, but I travel with them, but that's a different issue. But I don't have that many of them, and they just sort of sit there and wait around. But this dramatic, something like, again, you can correct me, but over 80% of the value of outstanding US currency, I believe, is in $100 bills. And it would require that each one of us have thousands and thousands of dollars per person in our household in order for us to actually have it domestically. So it's outside the country. Do I actually care about why would, I mean, it's a great business, okay? It costs what, about 20 cents to make a $100 bill, even with all the current features? So the profit margin's pretty good. But why do I need to work? Why can't I replace all of that with central bank digital currency?
Yeah, so what you're referring to basically is the underground economy and the drug trade.
Outside of the country.
Implicitly.
Yeah, well.
And I think that's right. So the branch in the United States that has the most currency going in and out is the Miami branch. I don't think that is by coincidence. And there are countries like Ecuador that have a dollarized economy, and the Atlanta Fed sends them ones, fives, and 20s and gets hundreds back. So I do think that for larger transactions, particularly transactions that you may not want a record of, a $100 bill may be the preferable way to do it. I would say there are plenty of other ways now to transfer funds that can fund illicit activity. Bitcoin, cryptocurrency, stablecoin are all examples of ways that you can move fairly large sums of money, and while it's not completely untraceable, it's not that easy to trace. And as a result, I think there are other alternatives. I mean, if I had a choice between having the government issue a $100 bill that's an interest-free loan to our federal government, or having the illicit trade go in some cryptocurrency, I'd probably prefer them to use hundreds.
So that actually gets to another point, which is that do you think that the issuance of central bank digital currency will help in combating the problems that might come from stable coins?
I think they would, actually. So what's backing a digital currency is the full faith and credit of the US government. What's backing a stable coin depends on the stable coin. If you're not careful, you can end up with a stable coin that holds a set of assets that are quite risky, and there have been a couple stablecoin failures. But even those stable coins like Tether that are fairly established, making large transactions, they basically have a portfolio of a very risky money market fund. And we bailed out the money market funds in 2008. We bailed out the money market funds again during the pandemic. There were runs. The Boston Fed actually ran the facility to try to prevent the failure of the money market funds. And they're investing under SEC guidelines that are pretty limited. They're basically buying commercial paper, CDs, assets that you wouldn't normally think are all that risky. But in a crisis when credit spreads widen, they actually become quite risky. So I think stable coins, particularly of the unregulated variety that we currently have, do pose financial stability concerns and other concerns that a digital currency would not have.
Well, and the money market funds probably are required to have financial statements that are audited by reputable auditors as opposed to ones at least I've never heard of that are in the Cayman Islands. But that's just me. And that's just tether. Finally, this is a conference. This is part of a larger conference, a week on fintech, and we should touch on a couple of technical issues, especially because they were related to some of your Project Hamilton stuff. There's some papers that have been put out about Project Hamilton. There's also, for those of you that care about the technical side, the White House Office of Science and Technology issued a report on design choices for U.S. Central bank digital currency. That was, I don't know, I get my weeks mixed up. I think it was 2 weeks ago that came out, but I was on another continent last week, so that's my confusion. They had a few, and maybe you can comment on some of them. About the design choices, the first one was the degree of intermediation, interoperability between private and public payment systems, whether these things should be held in permissioned or permissionless, I'll call them databases, because I think of this all as just being entries in databases. How you should deal with privacy. And finally, I think how you deal with errors. These are interesting. They're interesting questions, and they raise in each one of these cases they raise technical choices.
Yeah, they do raise technical choices, and every country is going to make its own choices about where it's comfortable drawing the line. I think privacy is the best example. I think different countries are going to have different choices about how much privacy they want the individual to have in order to be able to open up an account. In some countries, there probably will not be very much privacy. In some countries, I think there will be a great deal of privacy, and they'll only require the minimum amount. And basically, the bank secrecy and know your customer rules are global rules, so I would expect those are going to be enforced around the world. So in that respect, I don't think there'll be differences there. But in terms of the additional information, my guess is that most Western countries are going to choose a model that gives a pretty high degree of privacy to the individuals. This is, though, an account that's going to have a Know Your Customer and a Bank Secrecy Act SIV to open up the account. So it's not going to be like some other alternatives that would not require anything other than you send them money and you have an account, you're up and running. It will not be like that because of these other concerns that the government has.
So in a lot of ways, you're describing something that's layered on top of the banking system, or as part of the way that the banking system already works.
Yeah, I'd say it's layered through financial intermediaries.
Okay,
so
more accurate.
Banks would be one way to be your portal in, but it wouldn't have to be a bank. And I could easily imagine fintechs and other types of organizations getting into this. To be honest, banks are not particularly good at reaching low-income individuals, and I think there is a good reason to try to broaden that out, to try to get organizations that are going to be much more focused on inclusion. And maybe we have to, in the end, subsidize it. I'd say of the countries that are doing it, many of them are starting out by basically going through bank rails, because that's what central banks are used to working with. They're used to working with banks. But they're all planning on having non-banks also participate. They're all choosing a layered format. And I think that is the most likely way to go forward, is through this kind of layered format.
We'll find out ultimately how much it really costs to run one of these. I don't think we don't have a very good sense, right? Banks are full of cross subsidies, so we don't really know. We don't really have a good sense of what it costs to run a bank account, I don't think. But
yeah, I think, again, this is an interest-free loan to the government,
yeah.
So I'm not that worried about
the cost
working out. And I think the real-time payments, you're talking between 2 and 4 cents a transaction.
Yeah. Well, let's take some questions. We'll take if you put your hand up, I'm going to take them in groups.
Hi. Number one, thank you for your life service for life so long. We're very grateful to you for all what you've done. I had 2 questions. One is around crypto-like currencies and the impact of quantum computing. As you know, that is not that far away. And what happens to this whole ecosystem if that were to come about? And number 2 is you touched on in the context of other countries. If you look at ex-US, where you have the currencies depreciating all the time. If you had the choice of having a stable coin, would you not have that rather than have your money in the depreciating currency? And could you see other countries going down the same way as a few have already done so?
Thanks. There was one in the back there, I think. The microphone, please. We're actually trying to record this. So.
Fair enough. If I understood you correctly, you sort of said the financial stability issue wouldn't be a problem because of the size of these accounts. Given you're a room full of fintech entrepreneurs, you're basically saying no one's going to find a way around those small size accounts. Like someone's going to find an engineering solution if there's a need to have bigger ones, just like people got around Red T. I think would be my question to you.
There was another question here.
Hi, I'm Mike Wise with the Boston Blockchain Association, and Jim Cunha spoke at our event a couple last summer, and really appreciate his focus on inclusion. And also Anders Brownworth and Bob Bench. You got some really smart people on the team there that are thinking through these things. I wanted to ask about central bank and inflation, and what would there be an impact, or what would be the impact or advantage of CBDC on the economics of inflation?
Should we stop there and
Yeah, that's
and
probably enough.
we'll get another round.
Let me go backwards. I'll start with the central bank and inflation. What generates inflation is just not that currency in public. And so there are plenty of ways that the Federal Reserve can control inflation. It raises interest rates, it reduces demand in the economy to try to get demand and supply more in balance. That's what it's trying to do right now. I don't see these kind of accounts actually posing much of an issue. When you think about the money aggregates, actually a relatively small percentage of the money aggregates is from currency, and given these accounts would be fairly limited, I think the same would be true. So a lot of you look at M2 and M3, there tend to be the liabilities of banks, not the liabilities of the government that are the dominant feature. So I think that the Federal Reserve or any central bank would have the same ability to address inflation that it does now through the same tools that they're currently using, which is increasing short-term interest rates, possibly changing their balance sheet. So I don't think it affects that. Getting around the transactions. So far in the countries that have implemented, I don't think that's been a problem. That doesn't mean it couldn't be a problem. But the Know Your Customer is basically designed so you wouldn't be able to go out and have 20 accounts or 30 accounts or 40 accounts. So I think some of the Bank Secrecy Act, Know Your Customer, are basically an impediment to holding a large number of different accounts in order to be able to flow a lot of funds through that. It hasn't been tested yet. In the countries that are using it, it hasn't become a real problem. They are talking about raising the minimums in a place like Jamaica, for example, and in Nigeria. I would say that they're really at early stages, and in some sense, from the perspective of the United States, it is useful to have lots of other countries try to do a digital currency and see what mistakes they make. And we may find out there are easy ways to get around the rules, and if that becomes a problem, we'll have to think about a different design feature. To date, I don't think it's been a real problem, and I think you could design it so that you wouldn't be able to have, you would have, one wallet in the United States, you wouldn't have multiple wallets. But
Just make a quick comment. I mean, I think the other answer is that in financial regulation, the government and the private sector are in an arms race all the time, okay? And so, you might win for a little while, but then they'll get you.
Depreciating and stable coins. So you're right, if you're in Turkey right now, one option, given that Turkey has a very high inflation and has been lowering their interest rate to address it, that a
They're
stable
planning
coin.
to do that again, by the way.
That a stable coin would be one option. I was just in Turkey, and it's pretty much a cash economy. I had no trouble spending my dollars whatsoever. And I think actually that most of the people had dollar accounts, and they weren't necessarily stable coin accounts. So one solution is the stable coin, but as long as currency is still has not been outlawed, which would be my best guess, my guess is in many countries, holding lots of $100 bills will be, if they're worried about depreciation, that'll still be the way a lot of people do it. There are plenty of other assets that you can buy to avoid a depreciation. So I think it's a reason to get into stablecoin. I don't think that alone is a great reason to have stablecoins that are unregulated. But I agree with you in places like Latin America or Turkey where depreciation is a real issue. Yeah, it is. And that's why you have to think about, what are the limits on your wallet? Because otherwise, everybody does run. It's a financial intermediary. It can be a run on a bank, but it could also be a run on a country. And so both the central bank and the financial intermediaries have an incentive to limit it.
Take another set of questions, or we had one
It
in
was
the
like one
back?
more that I'd asked actually. The quantum.
Oh.
Like quantum.
He asked about it.
Oh, yes, about cryptography and quantum
Yeah.
computing.
So I would say one of the big risks is cryptography risk. A lot has been happening in this space, but obviously as it becomes easier to do transactions that break into these systems, that is potentially a problem. I don't have a solution to that, to be honest. I think there are plenty of smart people over in Cambridge that are thinking very carefully about that, and elsewhere. So I do think it is an issue about how the cryptography works as the technology changes.
CBDC is going to be the least of our problems if pretty good privacy breaks down. If there's,
Thank you for that very insightful overview. So my question is around AML controls, their applicability and effectiveness, particularly in this space.
there's another one back there.
To some extent, you commented on that, but I'd like to have more elaborate on to what extent, who and how would the intermediate layer, the wallets, for example, for CBDC, would be regulated? And why I'm asking this, because if you regulate too much, well, then they become just banks at the end of the day, compared to the fintech world.
Yeah, my question is, which platform are you interested in building the CBDC on?
Technical questions. One last question up here in the front. I'm sorry, DeBarshi's getting some exercise.
Okay.
And then I think this is going to be all we'll have time for because we have to go have drinks.
You talked about bank run and the disintermediation of the banking system. So the bank, their job is to collect deposits and give lending to productive or consumer. When that role is removed from the bank, who will play that role?
Okay.
So again, I'll take them backwards. So your question is kind of Steve's question on disintermediation. So yeah, the banks take deposits and they give loans on the other side of their balance sheet in a very simplified bank. I'm not viewing these wallets as being such a large percentage of the bank that it's going to be a significant impediment. So it's just like your currency. When I go to my bank and take out $250 from the bank, I'm removing money from the bank, and now it's a liability of the federal government. It's not a liability of the bank. The same thing's true for digital currency. So it's going to be pretty limited in terms of the size of the wallet. The fact that it carries a zero interest rate is going to make it not that attractive an asset. It's going to be used more for transactions. So I don't see this as being a serious problem for most bank intermediaries.
to discuss. Like for deposits, like for salaries and the payment, even just lately somebody I want to buy courses from, he said pay me in crypto. So that's outside the banking system. So all this making money and paying money will be outside the banking system, so it doesn't capture that value, and it goes only between P2P. So are you relying on P2P to do the lending as well?
So you're right that it would move, things would be moving much more efficiently.
Yes, outside.
So the money would transfer very quickly and somebody's going to do something with the money once it's transferred. More than likely, if it's a P2P, it's going to end up in a bank account or some other kind of account that gets a return. Even for a small business or a business, the same would be true. So I think the amount outstanding is not necessarily going to be so large that it's going to be that much.
Let me take a quick crack at this. We have about, I would guess, you can correct me again, let's say a third of all currency outstanding is actually inside of the country right now. That would be a number like $400 to $500 billion in actual cash. The idea I think that Eric has is that some of it is going to go into this. And so some of it, the cash, it's the cash you hold that gets transferred into central bank digital currency, not your bank deposit. So the bank continues to do its job. That's his vision. It's not.
That doesn't mean that, currency could be a little bit bigger or a little
bit smaller, right?
But I
there'll be
think what I would
risk.
emphasize is little.
Yeah.
That I would expect the stock of currency not to be a big impediment for financial intermediation. The platform for CBDC for the United States is not determined. I would refer you to the Boston Fed website. This project Hamilton is actually the Boston Fed working with MIT to have a technology platform. A lot of the people that the Boston Fed have hired did work on stable coins before. So the technical staff is using a lot of the stable coin kind of programming, but it's not a blockchain in part because you need scalability. So think about the number of transactions of people, if everybody wants to buy a candy bar at the same time, you have to be sure that that happens quickly. And so in a small country, so Jamaica is not on a blockchain, for example. Nigeria is on a blockchain. The Bahamas is on a blockchain. A small island economy where the transactions volume isn't all that large, a blockchain probably works perfectly fine. But to get the scalability you actually need for a large number of transactions, it's an open code kind of structure. And they provide in that the Hamilton working paper a lot more detail about what they're doing. Their initial focus was primarily getting enough volume and transactions that could credibly be used in the United States. They haven't layered on all the privacy and other aspects that presumably will slow down the process relative to, they were just checking on what the pass-through would be. So at this stage, it's not clear what the platform will be. I think it probably will not be a blockchain technology for the United States, but that'll be determined further down the road. I would say the United States is not kind of the front runner on any of these things. So we're certainly going to learn from some of the mistakes that other countries made. The Eastern Caribbean actually had to shut down their digital currency for 2 months. They had some expired certificates and people couldn't use the digital currency. Now they've solved the problem, which is not to have expired certificates, but it just highlights that there's going to be some learning going on with some of these technologies. And there's probably a good reason for the United States not to be first in line, because you shut down the U.S. digital currency, it's a little bit different than if you shut it down for the Eastern Caribbean.
So if I remember, the quantities that they were after were 1 million transactions a second with settlement in, what, 2 seconds or less? 4 seconds, okay. So that's, there's no blockchain technology at the moment that would allow anything remotely close to that. So that's what you have to, that's what the objective has to be, is that kind of throughput. Without that, you can't do it.
In terms of the wallets being regulated, again, this is a policy choice. You could easily have a wallet light, which is the main purpose is you have the bank or the other intermediary verify that you can have an account, that you're not using it for illicit purposes, and then other than that, they don't collect much other information, and the wallet isn't highly regulated. Now, if you're doing it through the banks are very likely are going to choose a wallet of their own design. I'm not so sure it's going to be the regulation so much as how the banks decide they want to create these wallets, and they're going to want to continue to think about what cross-selling opportunities and other things, and how the bank gets compensated for having the wallets is yet to be determined for their customers and going through the Know Your Customer. So I think that would have to be worked out. For the AML controls, I view the AML controls as basically being the same as what we have now. I wouldn't say they're perfect. So if you look at enforcement actions by the Federal Reserve and look at how many are related to AML, huge number, and a lot of them are very large banks. So it's not that straightforward to do AML, and it does require oversight by federal regulators. I would expect the same kind of oversight that currently occurs with banks would occur with any entity that's opening up accounts.
Great, thank you very much.
Well, thank you, Steve, and thank you, Professor Rosengren, for this wonderful discussion. And we have a reception following this where we can continue our discussions. So please join us. It's in the clubhouse, which is on the 6th floor in the other tower. So if you head down to the lobby, our colleagues will direct you to the clubhouse, which is where we're having the reception. And we have a little something for Professor Rosengren. Thank you for joining us.
Give your guests something to take home.
Thank you so much.
Thank you.